Greetings and welcome to Module 8, Stockholders Equity. We're going to take a deeper dive into equity, and we actually already covered the debt side of things, the liabilities, where we borrow somebody else's money, we pay interest on it, but the other methodology for financing a business operation is equity. And the big advantage is we don't have to pay interest, but we have optional ways of distributing money through dividends. So that's our choice, not the choice of the automatic interest payments that are due. So we're going to talk about different kinds of stock in the equity section. We'll get into dividends and EPS, earnings per share. And again, earnings is the same as net income, is the same as net profit, and per share is a number of shares that are outstanding. We're going to talk a couple of categories that go with that. So we'll examine stock as a financing source as opposed to debt, and we'll discuss the various features. So let's take a look at some of those features. We'll start out by looking at things like preferred stock. And preferred stock has a preference, and in GAAP, it is almost like debt, where there's usually an interest rate associated, and they get first dibs on dividends. In IFRS, by the way, preferred stock is not considered equity, it is considered debt itself. So it's categorized differently, but we're concentrating on GAAP this round. We have common stock, and we have a par value. In this case, it's $1 per share. We have 4.3 billion shares authorized, but only 3.1 billion issued. So we have capacity for another 1.2 billion shares roughly to be issued if we so choose. We'll talk more about that. We have AOCI, or the comprehensive income. We have retained earnings, which you should be pretty familiar with right by now. And then we have a deduction from equity called treasury stock. And these are shares that are bought back from the marketplace and are in our treasury, accessible to us if we want to use them for benefits, if we have employee compensation, if we want to raise the stock price. We'll talk some more details about that. So we're going to start with common stock, then we'll talk about preferred stock. So let's take a look at common stock. Common stock, there is such thing as no par, but in this case, we had $1 par. And most stocks seem to have a par value assigned. It could be a penny a share, it could be $1 a share, it could be 0.001 cents a share, a tenth of a penny. And then anything above and beyond, say, the $1 a share, if the share sells for $10, $1 goes into common stock on the balance sheet. $9 goes into something called APIC, or additional paid-in capital. And that's capital in excess of par. That's another term that's sometimes often used. So here we had $1 per share, anything in excess. Rarely do shares sell at their par value. The marketplace dictates what the values are. So we have authorized shares. We just saw that 4.3 billion shares were authorized. No more shareholder approval, no more things have to be done. So we can, as a company, issue more shares above and beyond what has already been issued, which in this case, $3.2 billion. So we have a whole bunch of shares that are outstanding that are issued. The catch is that we have a percentage of ownership with each share of stock. Let me draw a little example here for you. I'm going to go in and do a little bit of whiteboarding for you and get a feel for what we're talking about when we're talking about stock. So we have the ability to issue stock. And so the board is the one that will authorize, let's say they authorize 1 million shares. Right? And we issue 10 shares. Let's say you own 1 share of the company. Does that mean you own 1/10 of the company or 1/1,000,000th of the company? Well, the answer is 1/10, because 10 shares are all that's issued. And I'll also add issued and outstanding here, 10 shares. So that means we have 10 shares representing 100% ownership in the company. So we go one step further. We're going to go into treasury stock in a little while, and we're going to buy back 5 shares. So what does that do? It means there's only 5 issued and outstanding, and there are 5 in treasury. Now we've got 1 million shares potential that we have authorized to distribute. And if we actually have 5 shares issued and outstanding and 5 treasury, when we pay dividends, we only pay dividends on the 5 that are issued and outstanding. We don't pay dividends on the ones that are authorized that haven't been issued. We don't pay any dividends on the treasury shares that are there. So let's go back. We'll get rid of our treasury shares for now. And we'll say we have 10 shares that are issued and outstanding. So that issued and outstanding means if you own 1 share, you own 1/10 of the company. If you own 5 shares, you own 50% of the company. So the challenge with that is understanding that we can authorize a whole bunch. Now we can go ahead and issue 10 more shares. So what happens to the existing ownership? Well, if we issue 10 shares, and that will say 10 more shares, we now have 20 shares issued and outstanding. If you are one of the people that had one of those shares that you were holding on to, and you own 10% of the company, guess what? You now own 5% of the company. But you might be okay with that if someone was buying into the company at $1 million a share, because that's cash going into the company that in theory we would most likely raise the value of the shares you already have, the equity you already have. And we'll see how that comes into play in a few minutes. So I'm going to go back and reshare. We'll go back to the slides, and we'll take a look at what some of this means as we go. So we have that issued and outstanding treasury stock. The example I gave you was 1 million shares are authorized and 10 shares are issued. Those 10 shares would be 100% ownership. And that's if owned by 10 people, that would be a 10% interest by each. Let's jump into preferred stock. Preferred stock is, as I said before, more like debt. It often has an interest rate. It normally has an interest rate assigned with it. What that means is you are preferred when it comes to dividends. You get first dibs. And let's say there's a $10,000 worth of dividends to the preferred stockholders, and you declare 5,000 dividends. They all go to preferred stockholders. If you declare 10,000 dividends, all 10,000 will go to the preferred stockholders. If you declare 15,000, 10,000 of that 15 will go to the preferred stockholders, and then there's 5,000 available for the common stockholders. The catch with preferred stock is, even though it's called stock, it's more like debt. You don't have voting rights. You really don't have ownership rights per se. You just have rights on the dividends that you can get. And then there are 2 features that go with that, cumulative or non-cumulative. What that means is if this year we don't declare dividends, and next year we don't declare dividends, and the year after we do declare dividends, if it's cumulative, that means you have the ability to get back dividends, first dibs. So in our case before, if it's 10,000 and you declare 40,000 in dividends, and it's 3 years later, 10,000, 10,000, 10,000, that's 30,000, go to the preferred stockholders, and the other 10,000 is now available for common stockholders. Non-cumulative means if you don't get it in the year, it's in the year, following year you lose it, and the following year you lose it. So non-cumulative in our 3-year example, first year, no, you don't get your 10, sorry. Second year, don't get your 10, you lose. Third year, we declare 30,000 dividends, you are only having rights to the first 10,000, and then the common stockholders can get the rest. There's also a nice feature called convertible. You might be able to convert it into common stock if you so choose. That's actually a pretty desirable feature if you're a preferred stockholder, but you pay for it. So the cost of the preferred stock that you get will be a little bit higher to have that convertible feature. You may never execute that convertible feature. Maybe we say with one $1,000 issue of a preferred stock, you can get 20 shares. 20 shares into 1,000, that's $50 a share. And you might be publicly trading at $10 a share. And then you go up to $20 a share. Then you go up to $30 a share. Then you go down to $20 a share. Maybe you never reach that 50. Then it doesn't pay for a preferred stockholder to convert it. If they reach 50, 60, 70, now you're talking, okay, let me convert it to common stock. Now I've got a value, an increased value there. And Johnson & Johnson, J&J issued up to 2 million preferred shares, but to date has not issued any. So it's a balance of 0. We saw a 0 right here in that first line, preferred stock. By the way, this is the order you see things: preferred, then common, then additional paid in capital. If there is AOCI, retained earnings, and treasury stock. So we'll go jump back. We saw the preferred stock and have that conversation. Let's talk about some of the other items that show up in equity section. AOCI, accumulated other comprehensive income. This is changes in equity other than owners' investments. So what happens? We're going to have, and we'll talk a little bit more about it, but we're going to have things that we need to recognize, but we have not realized. Let's say you buy a share of stock, and the stock was $200 a share, and it went up to $400 a share. Well, until you sell that stock, in theory, you didn't make $200. Saying, yeah, but it's worth 400. I can get that today. Yeah, but tomorrow it might go down to 300. It might go down to 250. It might go below the 200 you originally paid. It might go to 150. So what do? We accumulate other things outside of the realized because we want to recognize. So we're going to recognize some of those profits, derivatives, pensions. There's a bunch of specific items that are thrown into other comprehensive income that we can't claim on our income statement. You recall that when we went into Edgar and said, oh, we're looking for an income statement. There it is. It says comprehensive income. We looked at it. It started with net income, which doesn't sound like an income statement because income statement starts with sales and revenues. And then it had a whole bunch of things on foreign currency translation and derivatives. And you start saying, that's interesting if we were a financial institution, but if we're a retailer or a manufacturer, that does not sound like my mainstream income statement, and it's not. We have retained earnings, which you're intimately familiar with by now, net income, added, dividends reduced, stock buybacks reduced. And then we have treasury stock. I mentioned it was a negative or an offset to the equity section. It's called a contra equity account. We have accumulated depreciation, contra asset. We have allowance for doubtful accounts, contra asset. We have sales returns and allowances or sales discounts, contra revenue, goes the other way. Well, treasury stock is a contra equity, which means it's deducted from equity as opposed to being added to equity. And why would we repurchase a company stock? Well, first, it could be undervalued. We think, our stock is worth a heck of a lot more. We're going to serve our shareholders better by reacquiring our own stock. Or we might need it for employee bonuses, or even to prop up the stock price. If you might know that if stock goes under $1 a share, it's subject to being delisted on the stock exchange. And if you're $1.25 and you go down to 94 cents, you might buy some shares back to get it back over $1. Or we'll talk about stock splits and reverse stock splits in a little bit too. Cumulative amount spent on stock repurchase less the amounts received for subsequent resale of the shares. So they're buying back their own shares in the marketplace. And at fiscal year end, the company held 457 million shares, for which it paid 34.36 million net for resales. Let's talk about book value per share. It's not the market value, it's the value on the books. We got the equity, and we remove the preferred stock. So we have Stockholders Equity minus preferred stock in the equity section, divided by number of common shares issued and outstanding. So we don't use treasury stock in there. We're looking at what's outstanding with the shares that we have, book value per share. All right. And then we have the market price per share, fiscal year 2018, 129, the company market book ratio was 575. So we're in there taking a look at our stocks, and we're saying, you know what? We're going to be calculating less preferred stock. We have outstanding shares that we worry about. Statement of stockholders' equity. We said the four statements were the primary statements: balance sheet, income statement, statement of cash flow, which will be in module 11. And then we'll be talking statement of retained earnings, which is a component of the statement of stockholders' equity. Usually you see stockholders' equity. So you reconcile the net income, dividends, cash raised from new shares issued. So to get cash in. By the way, the only cash you get is at the time of issuing stock. The stock value goes up. That's great for stockholders. It doesn't do yourselves any good unless you own treasury stock, which you can reissue at a higher price. Cash used to repurchase shares in the open market, changes in key balance sheet accounts. So we see here what the statement of stockholders' equity looks like. We get a feel for that. We talked about preferred stock before, multi-use security with a number of desirable features. So what we have, in addition to usual dividend and liquidation preferences, well, that was another benefit of preferred stock. At liquidation, preferred stockholders get their monies back before the common stockholders do. And there are two other features. One is the yield, and we said there's like an interest rate associated. So if we look at the interest rate, almost like interest rate on a bond, we're going to be having associated an interest rate that we get when dividends are declared. Again, it's cumulative or non-cumulative. The other feature I briefly mentioned was a conversion feature, and those two features are good for bonds too. So the conversion feature is good for bonds, where you can convert to a number of shares at a predetermined rate. And that is part of the covenants that comes with the preferred stock, or can come with a bond. The other thing with bonds, we talked about callable bonds. There's no such thing as callable preferred stock. So the convertible preferred stock, this tells the dividend is 4.25% on the par value. And it includes a conversion feature to exchange one preferred share for 50,000 common shares. That's a pretty good conversion on the dollar par stock. Then the common stock, par value of $1 a share. We talked about par. Arbitrary number, could be a penny. It's not really meaningful in the marketplace. Just because it's a par value of $1 and another stock is a par value of a penny, doesn't mean the penny's par value is less worthy than the $1 par value. It's just a random number assigned and has certain meanings if there's liquidation. Authorized shares, and then issues here. They authorized 4.3 billion, and they have 3 billion at issue. So if you own 1 billion shares, roughly, you own a third of the company. If J&J, Johnson & Johnson, decided to issue another 1 billion shares, out from under you, you'd go from 1/3 of the company owning 1 billion to 1/4 of the company owning 1 billion. The advantage is you keep taking in new monies, new cash, which in theory will compensate you for your reduced ownership interest. And there's also something called a preemptive right, where if that ever happens, you get first dibs on saying, I own 5% of the company. I want to keep 5% of the company before anything else gets issued. And you get the first opportunity to buy those shares before somebody else gets them. Then we notice J&J repurchased 457 million shares and dollar value associated. There are no voting rights, nor do they receive dividends. So if they issue a dividend, only the issued and outstanding, not the treasury stock, gets dividends. So if it's out there outstanding, if it's in use, great. If it's ownership there, great. If the treasury owns it, we don't pay ourselves a dividend. Number of outstanding shares equal to the issued shares less the treasury shares. We talked about taking treasury shares out of our outstanding. And the term market cap. Let's talk about market cap for a minute. Market cap is the gross value of a company. And how do you get that? Market price of a stock times the number of shares out there. So if we had 100 shares and the market price was $10 a share, well, 100 times 10, $1,000. That's the market cap of our company. If we had 100 million shares at $10 a share, our market cap would be $1 billion. That would be if someone were to buy all the shares at the current prevailing market rate of the stock, that's what it would cost them. And that's what our market cap or market valuation is when we're talking about companies, shares, and the like. Let's talk about non-controlling interest. This will be the last portion of this module. If you look at a balance sheet and income statement, you'll often see, especially on the bottom of an income statement, you have income attributed to non-controlling interest and income attributed to controlling interest, or more stockholders. So what happens? I'm mentioning down here, if a company tenders an offer, I'm willing to buy 90% of your company at $60 a share. They're trading at 40, and you say, I'll buy 90% at 60. And if we don't get 90% participation, I'm not going to buy. But it's going to be a vote by the board of directors. It's going to be a process to go through. And if I get 90% of the stock, that means there's still 10% of the stock that's not controlled by me, the company that's buying you. So if I buy your company and I buy only 90% of it, I have 10% of non-controlling interest. 90%, I'm controlling the place. 10% is not controlling, but they're entitled to 10% of the income. They can try to 10% of the assets of liquidation. They own 10% of the company. but they don't have the controlling interest. They get 10% of the board if they have board votes and the ability to get folks on the board. But non-controlling interests are very common in large conglomerates, multinational companies that buy companies all the time, but maybe the non-controlling is the original owners. They kept a share because the buyer wants the original owners to have skin in the game, to be part of it. So that non-controlling interest is separated and isolated on the balance sheet on the income statement. It's a proportion of the subsidiary stock not owned by the company, by the acquiring company. Non-controlling account increases with additional investments. That's not controlling shareholders put some more money in, that increases. And the share of net income will also increase their investment. Decreases will be caused by dividends paid to non-controlling shareholders and shares of net losses associated with a company stock they own. So there's ups and downs for the non-controlling interests, but those are folks that don't have as much of a say as those in control, because they're kind of a minority holding on to a smaller sliver of the equity when it comes to the stock of the company. That concludes our first module associated with Module 8, or first portion of Module 8. Thank you for listening and looking forward to seeing you in number 2.